I'd like to welcome my special guest today, Bob Hormats, Tiedemann Advisors Managing Director, but his resume is about 4 feet long. He's done a lot of different jobs in government, Goldman Sachs. Bob, it's great to have you today. Let's get right into it. The biggest question, biggest debate in my circle on CNBC is why are rates so soft and equities so firm? What is the driving force for buying treasuries and buying stocks, in your opinion?
Well, I think you're right. There looks to be a contradiction here. I think the buying force for treasuries is people still are unsure of the future of the economy because the question of whether there is some kind of cure, some kind of medicine for treating the coronavirus, and whether there is ultimately going to be a vaccine are still unknown, and the course of the virus itself is still an unknown. Things are looking better in New York and some cities. In some cities, they're looking worse. So this is sort of an unknown factor and very unpredictable. And in that environment, people look for the security of treasuries. On the other hand, ironically, the low interest rates, coupled with a big government stimulus and the prospect of an even greater government stimulus in the future, which is going to be necessary, has given people some hope that the economy will grow over a period of time. And when you get growth with relatively high dividend yields compared to the yields on treasuries, that's an attractive feature for stocks in many cases.
Now, another issue that many are weighing in on, and I hear it every day, is that behavior in life in general in the U.S. is going to be a lot different on the backside of coronavirus. And that may or may not be true. But I think the better conversation to have is how behavior among countries is going to be different. Think deglobalization. Think about all the pharmaceuticals and all the questions of drugs made in other countries that may be in short supply here. Think of manufacturing issues with masks stranded in other countries. Weigh in on the deglobalization aftermath.
You're absolutely right. There's a contradiction here, too. In one sense, the notion of long supply chains and heavy reliance on other countries is going to be questioned not only by our government and other governments around the world, but by companies. Do they want to be as heavily reliant on one supplier in a distant land for vital products, be they technology products, pharmaceutical products, medical equipment? So the notion of bringing more of the production home or diversifying it to a far greater degree will be, I think, a critical structural question, a strategic question for many companies. The other is, as we had after the oil crisis, the notion of strategic reserves. We have a strategic reserve for medical products. The Congress has appropriated $16 billion for that. And I think that we're going to have to concentrate a lot more on having the resilience of strategic reserves for many highly important products in the pharmaceutical area and in others as well. And this notion that was very attractive years ago of just-in-time inventories, that is going to be rethought too, because it turns out when there are disruptions in other countries, when other countries have to close down their capabilities to produce things, when supply chains become more questionable, you want to have strategic reserves of critical products under your control if you're a company. And that's going to mean a lot more storage capacity requirements and giving up this notion for many products of total reliance or heavy reliance on just-in-time inventory. So it's going to restructure supply chain thinking and inventory thinking.